Yeah, you see it. That's my tail wagging because we are live on Facebook right now. It is on Thursday edition of the Not Your Average Investor Show. We are back every Thursday. And I am your host, Pablo Gonzalez. With me is the property analysis expert, real estate genius, entrepreneur, leader of the community, Ernest & Young, future entrepreneur of the year. I'm going to call it right now. You're winning the award this time, Gregg Cohen. Say what's up, Gregg.
Wow, man. I don't know if my head is going to fit through the door when I walk out of this little closet that we have here that we call a studio. Thank you for that incredible introduction. I'll take one of those words as being accurate, and the rest of them, the Ernst & Young finalist we'll take. I don't know if we're going to win, though, but we did just go through the final interview yesterday. It was an incredible process to get there. And I think we got a good shot. So keep sending all of your positive vibes. We'll find out in about a month.
Oh, man.
So very
That's so
excited
cool.
about that.
Awesome, man. I'm excited for that. I'm excited to be hanging out with our group of friends that we are now having this Thursday ritual. It's just a couple of folks hanging out, talking about properties, educating. This is the call where you, who is hanging out with us, gets to participate the most. Two ways to do that. One way is to talk to us and your fellow attendees. Hit that chat button. Drop down the blue button right above where you type. That's right, Marilyn Cotterman. Positive vibes. This is what we're doing right now. Hit that blue button that says all panelists and drop it down and put all panelists and attendees. That way, everything that you type goes, everybody else sees, and not just me and Gregg. You don't want to hold your genius to yourself. Let's share it, right? Let's make a new friend. Let's network here while we're at it. And second is, if you want your question asked live on the show, you want me to ask Gregg the question, the best way to do that is to pop open the Q&A box to the right, put your question in there. I try to track everything, right? Even if you're putting it in the chat, I've been known to ask a question from there. I've been known to ask a question from the Facebook group, but there's a lot going on. I'm also trying to absorb the knowledge that's coming out of Gregg's dome. So if you don't want me to go cross-eyed, use that Q&A box, and that is the best shot. And last but not least, once you are done here, what is the next move? The next move is to go to jwbwebclass.com, where you can, number one, spend a little bit more time with Gregg, telling you everything you need to know about rental property investing. And two, you can get the free investor toolkit, which is one of the things that we are going to be messing around with today, is this property evaluation sheet that you're going to see is very interactive. You get to pop in numbers and change things and ask questions that you want answered. It'll answer it yourself. And I want to welcome everybody that's chatting here. Bernard Griffin, welcome. Thank you for putting in there. Marilyn, welcome. Lee, as always. Guillermo, it's good to have everybody. I'm sure we're going to get a yo from Jake Hargrove at some point here in the chat box. But right now, Gregg, it's you, buddy. It's on you to teach us about this new property that we got on. But you just mentioned, I want to touch it again. You are in the finalists for the Entrepreneur of the Year Award. Last week, you had just had an interview. You felt like you got there flat-footed because you had just taken a West Coast to East Coast overnight trip from Oregon.
Yeah.
You just had your second round yesterday. Did you feel a little bit better?
I do. And if I think about where we were last year was the first year we were nominated as potentially being a finalist. We got to the finalist stage last year, and I just felt like when I got there, it was this incredible setting of these business leaders that I just felt were just miles and miles beyond where we were. I literally felt out of my league. And we didn't win last year, but I remember the judges were so tough. So what happens is you sit in a room of there's two panels of judges, incredibly successful entrepreneurs themselves who've all won the award in the past. And they're grilling you. They're grilling you on your numbers. You know, how did you increase your revenue by this percent, but your net income by this percent? What's your cost per head count, and why is this growing and whatnot? So you have to know your numbers. And then just a lot of other, really pretty difficult questions. And this year I just felt like we were better prepared. It was Alex and I. And at one point, Alex is my business partner. He's our president. We've known each other since high school. We've known each other for 20 years. And so I think part of the fun is being able to poke fun at each other, even in a setting like this. So we were able to do that. We were able to get the judges laughing a little bit, which is always a good thing. So, we'll see where the chips lay. But the really cool thing to share with everybody is this year, when they announce it, it's virtual, as we would all know, right? Last year, it's this black tie event that, only the people in the room get to find out. So if anybody would like to follow along and be there for the announcement, we'll send out the information. I believe it's October 8th. Can't remember if that's the exact date, but you all can kind of join in as well and see, if we win. There's 21 finalists in the state of Florida. JWB is honored to be one of those. And so we got a decent shot. So keep praying for us, and hopefully we bring home the hardware.
Do the judges know that you're the star of the Not Your Average Investor show? I mean, are they asking for an autograph on the way in? Did that happen?
Dude, it was the reason that I think they nominated us. I mean, even last year, it was like a 2-year plan for them to potentially have them on the show, and all of the other good things JWB has done probably didn't even matter, to be quite honest.
A lot of people talking about it. There's a lot of people talking about it. All right, Gregg. So you said that you had to break down numbers, and today we're going to show exactly why I think you're going to win that award, because you're going to break down some numbers for us right here. This is our JWB Rental Income Property of the Week.
Week.
3604 Ledbury Drive, South, Jacksonville 32210. Gregg, what neighborhood is this in? Is this that West Side neighborhood?
That's right, Pablo. It's in the West Side. It's one of our most densely populated JWB turnkey rental property neighborhoods. We manage over 3,600 homes all across Jacksonville. I would imagine well over 1,000 homes are on the West Side, and 32210 is one of the most popular zip codes on the West Side for us. In fact, you want to start? I don't know if you've got the Google Maps loaded, but why don't we start there? We'll start 1,000 feet view, and then we'll drive in there.
Lucky for you, I am a prepared man, so I do have it loaded. Just got to switch screens here. Boom. Seamless.
All right. So there's our beloved Jacksonville. And to acclimate everybody, that's the St. Johns River that's going through the middle of Jacksonville. If you were to zoom out, you'll see the Atlantic Ocean on the right side of the screen right there. And so the West Side is everything that's west of the St. Johns River, which is right there in the middle and south of I-10. I-10 is a major interstate. Of course, it goes all the way out to California, and one of the ways that we are a logistics leader here in Jacksonville. So this area where you see 3604 East Ludbury Drive, that's the West Side of Jacksonville, an incredible neighborhood for positive cash flow, while also being in that cash flow sweet spot neighborhood. It's poised for growth because it's in Jacksonville, and it's that below middle income neighborhood that we desire that can get positive cash flow, and also be in a neighborhood that, as your property manager, we know, love, trust everything about that area. We know it. We have experience in that area. Because what you don't want to do is you don't want to fall too much in love with the numbers and the positive cash flow that you start to go to the low income neighborhoods. They will look good on paper, but it will cost you in the long run because you won't find the right resident who wants to stay there for a long time. That's the key. So 32210, for all of you who are following along at home, is a great neighborhood and a great zip code for below middle income cash flow positive rental properties.
And Gregg, one of the things that you talk about is the income level, the price point of the house, so that it's cash flowing, the rating of the neighborhood, right? It can't be a violent neighborhood, but you also talk about proximity to jobs, right? Mm-hmm. And this area here, right? Like you see, you are a stone's throw from downtown, but there's also around here, there's a military base, right? Which is a major employer in this area. Am I right? Kind of like where I have my cursor?
You are close. If you go a little south and to the east, you'll see NAS Jax, Naval Air Station Jacksonville, the largest Navy base.
Okay.
In Jacksonville, we have 2 Navy bases. Yeah, there we go. Over 20,000 jobs. Go to the right.
Oh, here it is. Okay.
There we go. Yep. Naval Air Station Jacksonville, right? Over 20,000 jobs right there on that Navy base. And many folks live off the base and rent in those areas right around Ledbury. And we talk about Amazon a lot. Amazon started to invest in Jacksonville in 2017, building their first distribution facility. It was the single largest announcement, or the largest single day announcement of jobs in Jacksonville's history. It was 1,500 jobs. That was their first distribution facility. Since then, they've continued to add other distribution facilities. They just made an announcement that they're on their sixth distribution facility since 2017. And one of the distribution facilities is right near Ledbury, a little bit to the west of Ledbury there. So yes, lots of job creators. That's incredibly important to make sure that your residents have those types of jobs that we want.
Okay. So we have zoomed out. Now we're zooming back in, right? We're in the right place for cash flow. We're in the right place for attractive property management conditions, and the right place to, for the demographic that you are seeking to live inside of your home. First thing I look at when I see this home, Greg, again, this to me says renovated property for two reasons. One, it's this kind of like block home, which isn't what I normally see that you guys are building. And I also see a lower sticker price. Is that accurate?
Absolutely. So this is a renovated home. We love renovated homes. We love new construction homes. We love them for different reasons. Pablo, compared to a new construction home, is a renovated home lower price point or higher price point typically?
Lower price point of the home.
There you go. Right? Compared to a new construction home, are your property taxes lower or higher for a renovated home?
Property taxes would be lower for a renovated home?
You're right. I know you were guessing because we'd never gone over this before. This is one of the things that I wanted to use as a teaching tool for everybody, right?
Excellent.
The big thing is that new construction, renovation, we love them both. I have them both in my portfolio. I own over 300 rental properties, and a lot of them are renovations. A lot of them are new constructions. Now, the way that you get to your decision is based on the rate of return, right? Renovated homes, new construction homes, each perform very well. Many folks say, well, am I going to get a higher rate of appreciation with new construction than I am with renovations? And what I let them know is it depends on your horizon. Folks who are coming to this asset class and coming to JWB want to hold long-term. This is not a fix and a flip thing. Right? To be able to get the best return on your investment with rental properties, you need to hold for a full market cycle, which is 10 to 20 years. And what I tell them is that after 10 to 20 years, your brand new construction home is not new construction anymore. So it is going to perform as far as an appreciation rate like other homes that have been built 20 years before it, right? That's just the way it is. So when you're comparing new construction and renovations, we need to focus on the rate of return. And the way that we get there is that we want to be between 9 to 11% for a conventionally financed purchase. You can see there that we're at 10.4%, we'll call it, near the top of the scale there, which is obviously one of the reasons that I chose this as our featured property of the week for you all. But as I keep saying,
go ahead. No, continue.
Well, as I was going to say, but the way that we get to that 10.4% is different for a new construction versus a renovation. Renovation, generally your purchase price is a little bit lower, which is great, right? We've been reviewing new construction properties in the past, over the past month or 6 weeks or so, and many of those have been $200,000 or above, right? So this is a huge home, over 1,800 square feet for a renovation, and still isn't at $200,000, which is different. If this was a new construction home, it would be more, right? So your path to getting to 10.4% returns is helped by it being a reno. Generally, those are a little bit lower on the price point scale. All right. Property taxes is something else that is lower generally for renovations than new construction. Property taxes largely go in line with purchase prices or market value. So that would make sense, right? You're going to save a couple $100 here on this property because if this was the new construction, it would have a higher purchase price, a higher market value, and the property taxes might be $300 more or so per year, per year. So you're going to save some money there. That's going to help you. Now, one thing that's not going to help you is your insurance cost, right? Remember what insurance costs are for new construction homes, Pablo?
Yeah, the new construction has lower insurance costs, right?
That's right. Normally it's around $450, maybe even a little bit less, maybe a little bit more. But yeah, sub 500 for insurance costs on brand new construction homes, even when the market value is $200,000 or above. And that's because it's a lower risk profile for the insurance companies, and you're able to save on that and lower insurance premiums. So the path to get to 10.4%, you've got to have lower purchase price. Your property taxes, generally speaking, help you a little bit to have lower costs there. You got to account for the fact that you're going to have a little bit higher insurance costs to pay for that same house, because that's just the way it is, right? And then something else to point out, right? Let's go over to the vacancy and the maintenance rate, all right? Now, for those of us who are following along over the weeks here, you'll see that your vacancy rate and your maintenance rate is a little bit different here for a renovated home than a new construction home. This is one of those things that most new and experienced rental property investors never take into account, is a different maintenance cost for the type of asset. And the reason is because most turnkey property providers don't actually track what their maintenance costs are, and they just use some really low numbers out there. They might say 5% for maintenance cost or 7% for maintenance cost. They're literally just throwing that out there. And many times they can't hit that. Well, we realized this was a problem because we care about hitting your return on investment. And so since 2011, we've tracked every dollar in and every dollar out for maintenance costs across new construction properties, across renovated properties. And we know with certainty over a portfolio, there've been over 2,000 properties that have been purchased since that time. And we've seen how they performed. And it comes in at a 6% rate for a renovated property. If it's a new construction property, as you would imagine, it's a little bit lower. It's 4%. So knowing this, taking this into account allows us to prepare return evaluations that are accurate, that we can hit over time, gives us an opportunity to under-promise and over-deliver, and allows you to make the best decision with being informed. And this is where most rental property investors don't have the data. Most turnkey providers don't have the data. And this is where a lot of people get burned. This is why your friend or your family member who didn't want to come to rental property says, oh yeah, the maintenance costs were way too high. Well, they just didn't work with the provider who actually knew what their maintenance costs were.
That makes a lot of sense. And I see, so first of all, I want to ask you something. Does the vacancy rate vary between new construction and renovation, or is the vacancy rate a neighborhood thing or something else?
You know, we've tracked it and we haven't seen a variation. So actually 3% is what it is for both new construction and for renovations, but we track it. If it would change, we would see it and we would update our evaluations.
Great. And again, it's 2,000 data points, right? So I think it's a pretty solid population, right, of data points. And, you know, this is the time where we got to talk about this little puppy right here. You have 0% appreciation right there. I'm hoping that you can explain if you think that, does that mean that properties don't appreciate in Jacksonville? Is that what's going on here, Greg?
Man, if there was a softball ever lobbed up there, that's what I'll call that one, right? That means, so the reason why we put zero appreciation there is because a couple things, right? First of all, I don't want to say this because many people have never heard this before, but I want to share with you that property appreciation is not speculative when you hold on for a full market cycle. If you look at the data, what you'll see over time is that within a specific region, within Jacksonville, let's say Duval County, right, or whatever region you're investing in, if you go and you see what the historical appreciation rate is on average year over year, and you start investing in the beginning of a market cycle, which is known to be between 10 to 20 years, what you're going to see is that by the end of that cycle, your appreciation rate should match the historical appreciation rate, right? We've seen this in Duval County in Jacksonville, right? Starting since 1991, if you go and look at the Federal Housing Finance Agency, you'll see that Jacksonville's historical appreciation rate is actually 4.3%. And at every market cycle since then, it's been over 4%, right? The one that is most glaring to people is if you look at the market cycle that encompassed the Great Recession, right? In the Great Recession, prices fell over 35% from 2008 to 2011. The biggest drop that we'll ever see, hopefully, in our lifetime, right? But if you go out from 2001 to 2020, the average appreciation rate year over year in Jacksonville has been 4%, right around that historical appreciation rate of 4.3%. So when you know that and you invest for a long time, you should be taking property appreciation into consideration. And the reason that we put 0% there is because a couple things. I want to under promise and over deliver. It feels a little weird to get out there and say, hey, you should expect 20-something% returns. I mean, that's just feels a little weird, right? The other thing is I don't know that every investor that purchases with us is going to hold on for a 10 to 20 year cycle, right? I tell them they should, but sometimes they don't, right? And so if you're not holding on for a full market cycle, then appreciation is speculative, and I don't think you should count on it. And that's why we don't put it there. It's also because we want to control what we can control. And as you would see as a client is every month when we report on our numbers, we report based on what our cash flow returns are. That 10.4% return is what we hold ourselves accountable to on a monthly basis. And so that's another reason why we put 0% appreciation there. But yes, appreciation is real in Jacksonville. It's the reason that you come to Jacksonville versus going to a Cleveland or a Kansas City or a Memphis or a Birmingham. You come because you want positive cash flow. Yes, you can get that in Jacksonville, but you also come because you want better long-term appreciation. And so I'll get off my soapbox there. Thank you for that softball, but we can absolutely count on 4% appreciation, assuming you're holding on for a full market cycle.
Well, Greg, I got a good news for you because I got another softball for you. So I put in 4% here in the appreciation rate, right? And these are the softballs that we do so everybody gets up to snuff, and then we go into questions, right? So I put in 4% here, right? Like if you go from 0 to 4%, that 10.3% jumps to 24.91. You want to explain why that happens and why it only jumps another 4% on cash and it jumps almost 15% here on unconventional financing?
Absolutely. So the reason that you see a larger jump, first of all, let's just talk about the magnitude of that jump, and then I'll explain the difference between both of those. Right. We just took an investment that was performing at a 10.4% return, didn't factor any appreciation in, and we factored in historically accurate appreciation, right? Not even top line appreciation. If I was to actually put what the appreciation rate is over the last few years in Jacksonville, it's actually more than 4%, right? But if we just put historically accurate appreciation in there, we're now showing an asset when looking at all the profit centers that's about a 25% return on your money, right? When you look at that and you think about that can be done passively, right? You can invest with JWB and we can manage this entire thing for you so you can live your life, have your job, spend time with your family, right? Normally when you're getting 20, 30% returns on your money, it's when you're out there and you're the active investor or you're taking a tremendous amount of risk, right? It's not normal to have a passive investment that you can earn 25%. But when you're looking at the full profit centers, and this is why I urge clients and I urge investors out there to hold on for a full market cycle. When you're looking at the full market cycle, this is what rental property investing can do for you. Something else I want to point out is the difference, right? We just took it from a 10% return to call it a 25% return. Pablo, which is the bigger impact to your 25% returns? Is it the cash flows and those profit centers, or is it appreciation?
It's clearly appreciation, right? Like if you are extrapolating this over time, right? Like there's only so much that you can gain from the cash flow, while that appreciation combined with the leverage that that you just explained is where it makes a big difference.
Absolutely. So 15% versus 10% is huge year one. It only grows from there. The spread of the returns goes more in the favor being, returned by appreciation than cash flows as it grows and compounds over the years. But for those investors who are out there that say, I'm just going to keep my cash flow blinders on, I only want to make a market decision based on cash flows, this is what you're giving up. You're not just missing a small piece to the total return equation. You're missing the big piece, the piece that dwarfs the other profit centers, right? So this isn't saying that we should go out there and only search for appreciation, because cash flow, positive cash flow, turns this into an asset and not a liability every year, every month. But once you've accomplished positive cash flow in a market, like you can do that in Jacksonville, then you need to look for the other profit centers. And this is how the most successful investors build a substantial portfolio. It's how they accomplish their financial goals over a period of 5 years, 10 years, 20 years. It's by making an asset decision where you can earn a 25% return on your money and do it passively versus making the same decision in a different market and not getting as high of a return on your investment. All right.
All right.
Man,
So that,
I'm just fired up today, man.
yeah,
I
I know.
love talking about this, by the way. Thank you everybody for giving Pablo and I the opportunity just to be here and chit chat about this. This is fantastic.
This is great, Greg. Listen, I've got one last question for me, and then I'm going into everybody else's. Normally here, I think this might be the first time that we show a 5-bedroom house, right? A 5-bedroom house seems pretty big. Is there a different way to consider investing in a 5-bedroom house versus a 3 or a 4-bedroom house?
Not really as far as a different way of considering it, but with a 5-bedroom home, you get some really high rent rates, which is what we love, right? So that's going to lead you to having a higher return on investment, right? That's why this one's closer to, 10.5% return. That's on the higher end of the scale. Well, part of the reason is because we're able to generate a $1,424 average lease term or average lease rate. Which is incredible. So yeah, I think it's great to point that out. We love 3-bedroom homes. We love 4-bedroom homes. We love 5-bedroom homes. We love 2-bedroom homes when the numbers work, right? But when you have a 5-bedroom home, it's nice and it's easier to get the numbers to work because you're able to command a higher rent.
That makes a lot of sense. And again, you always reverse engineer from the rent to price ratio and the cash flow ability, and then everything else is secondary to that, right? Like you got to start there, and from there on out, it's just like where everything else fits in, the neighborhood, the maintenance, the ongoing costs, and stuff like that. So you are
Yeah,
agnostic to what kind of home it is, right?
agnostic, right? Yeah, renovations, new construction, right? The number of bedrooms doesn't matter for me, right? It's not factoring into my decision. The only thing I would say that's maybe slightly a variation of what you said there is we start with the return on investment. The rent to price ratio is one component that can get us to the return on investment, but that's no more important to me than lower insurance costs or lower property taxes or whatever that may be. It's however that combination can work to get to the end result of 9 to 11% returns is a win in my book.
Okay, so good clarification. So it's rent to price ratio plus all the other costs plus the other profit centers, right?
Yes.
Which are?
The other profit centers, you're going to experience tax savings, which is where we basically are able to use the write-offs that you get from rental property investing that you don't get in the other asset classes like the stock market to limit your federal income tax. And then the other profit center that we haven't spoken about is principal pay down, which is the reality is that your resident is paying down your loan for you. So while you might not see it in your bank account every single month, there's $150 or $200 a month of your loan balance going down, which you didn't pay for. Your resident paid for that and then paid you positive cash flow on top of that.
All right. Now we're going into our user generated questions, and we got a bunch, man. This is a great call. We love the more questions, the better. So super happy to have a big list of these to go through. First one, Greg. Monique Terry asks, please comment on renters' habitudes or caveats you are seeing due to eviction moratoriums, which will affect cash flow long term.
I want to make sure was it renter attitudes is the question?
I believe the word is habitudes, which is
Habitudes.
a wordly wise word for me, right? I think this is behavior, right? Like what are like renters' behaviors and caveats that you now have to make based on the fact that there's this moratorium on rents. Is there anything going on there that's going to affect long-term cash flow? And if I'm wrong, Monique, I would love to be corrected on it. I pride myself in my language.
She said she created it. Behavior changes. I like that.
So it was. I like it. I like it a
Pioneer.
lot.
I like that. So I think let's take a long-term approach to this. Many folks have asked, are we changing how we qualify residents when we put them in the homes? Are we changing, people are concerned that it may be harder to rent homes in today's environment. People are concerned about renting and collecting cash flow and collecting rent for our owners. We are not seeing any challenges on either of those fronts. We are renting more homes than we ever have. And part of that is that we're positioned to do this in a socially distanced environment. We started doing this years ago. We started to do self-assisted showings, and that allows us literally to have thousands of leads that come in every single week to go and to schedule their own showing and then to rent. So we don't have any concerns there. We're renting more homes than we ever have during COVID. And rent collection for us has been incredibly strong. We've been over 97%. In fact, for those of us who are in the Facebook group, I go live in there almost every single day. I just did a September rent collection update where I shared that we've had our 5th consecutive month of over 97% rent collection. Now, are we making changes on how we qualify our residents or how we lease homes or how we, collect rent? By and large, no. I mean, we made some changes. This is COVID. Everybody makes a few changes, right? We used to have lease signings in the office. We don't have them in the office. But the main pillars of how we manage and collect rent for our owners are strong. Now, the eviction moratorium is a challenge. It's a challenge for those who have had a resident who hasn't paid rent. It's a challenge. There's no way to sugarcoat it. Your rent collection is your losses in the short run or longer, because we cannot evict that person, and that's uncollected rent. It's affecting a relatively small portion of our clients. I feel for those clients. I'm one of those clients too, by the way. I have homes that have been affected by this too. So I don't have a good answer for that, right? That's one that I don't. But I know that overall, this is a consistently performing asset class for our clients. And I know that this COVID and this eviction moratorium is temporary. As far as behavior changes and attitudes in residents, we've had really great communication with the majority of our residents. There's a few that we haven't, that, I don't know their situation because we haven't had communication with them. But by and large, it has been a process of working with our residents, even the ones that are going through challenges, right? We've been so accommodating with payment plans. We haven't charged a late fee all through this process. And so we've been incredibly accommodating. And the most important thing is treating our residents with respect and with empathy and communication and solving a problem. So there might be a longer payment plan than we typically would have done. But the key here is treating people the right way, keeping them in your homes and getting some form of payment. And we've been able to do a really great job. That's how we're able to collect over 97%.
Awesome, man. It's amazing to see the month after month, the numbers come in, right? And I know that you are very sensitive to the fact that there is that 3% are losing short-term cash flow. But I'm going to fence test a little bit. I'm going to explore here, kind of put you on the spot. For a person that is buying a new property, right? So like this is, I would assume that those 3%, those are people that have had residence in place for a while. For someone that's buying a new property, where do you put that risk of that new property not having the tenant, right? Because we just did that property management thing of how well you vet out your tenants and whatnot. Like, should somebody that's looking to buy a new property consider it the same kind of risk? Should I look at it as a hedge against the risk of the other one not having cash flow? So then now you have one that has more cash flow and less risk. Can you kind of talk to me about that?
Absolutely. So there's a fear out there of purchasing now amid COVID, right? What happens if I buy this asset and it's not collecting rent, right? And you need to compare that for your decision compared to your other choices of what investments you could make, right? Here's what I would tell somebody who is buying a property now is, number one, the house is going to be rented at the time of purchase, okay? And the type of resident who it's rented to is going to be the COVID challenge, the chances that people are losing their jobs in a high number right now is much less than what it was before. I mean, we had, 10 million job filings for unemployment a couple of months ago, right? They're way down now. So, and a new resident who gets placed in your home, which has recently just been built or renovated, just had to go and document their job in order to get qualified to rent with us right now, right? So the chances of COVID affecting somebody and then leading them to unemployment today is not the same as what it was in the past for COVID. Does that make sense?
Yeah,
right?
that's why I was asking, because that intuitively that made sense to me, but I wasn't sure if I'm just like the optimist that thinks JWB doesn't do anything wrong, which is true.
No, I mean it's real. I mean, I don't want to come out here and say that it's harder to rent from JW. Our standards are the same that they were before, but the reality is that if we were renting homes in February, right, we put people in before the COVID impact was hit. A lot of Americans lost their jobs in March and April, right? And it would be reasonable to assume that that might impact somebody, put them in a situation where the resident would need to be evicted and they couldn't evict, right? The chances of that happening today are so much lower, right? It's basically the same as what it was a year ago, right?
Yep.
So if you're looking at this today and you're deciding and saying, hey, I'm looking at this as a better risk-adjusted alternative than what I'm finding in the stock market. It's a way to diversify. And the only thing that's holding you back is you're concerned about COVID. The COVID effect has passed, right? As far as rent collection for a new person buying a brand new home or a renovated home and putting a new resident in, right? Our clients, myself included, who have some rental properties that were affected by COVID, we have to deal with the fact that there's an eviction moratorium in this temporary state, and we can't evict those people. But if you ask those clients, if you ask myself, right, that's a moment in time, right? I'm here to invest for the next 10 or 20 years or longer for my portfolio. You compare what the expectations were for the cash flows going into the investment, compare where we are right now, a few extra months of vacancy is not going to change how strong of an investment it's been.
That makes a lot of sense. And I want to go back to a couple of things, right? The chat's kind of blown up because Naya Frank says, I went to see one of your rentals to rent for myself, and indeed it was really easy, the steps to see the property. Bernard Griffith said, same here. My family and I were able to, even before the current situation, to be able to view the home on our own schedule without waiting for a third party to walk us through. Brilliant tactic. So it shows how well you've enabled the filling of these homes, even in this scenario. And the other thing is, you mentioned the Facebook group. Every time you mention the Facebook group, I want to bring it up. I put it in the chat. Join us, jwbfacebookgroup.com. That's our little secret cool club that has almost 1,700 people in there that are all real estate investors or soon to be real estate investors. And Gregg goes in there live, and that's where we all hang out in between calls. So I want to encourage anybody that isn't part of that Facebook group to join us there. But well explained, Gregg. And it's kind of how you tell me all the time, like a great way to hedge on your current rental income property is to buy another rental income property, because now you're diversifying that like cash flow risk. And if you're having that moratorium happen in one of them, then you're having that supplemental income coming from another one. Which is why I asked on how that risk plays out. So
yeah, I think that's a great point. I mean, what I tell people is that you're coming to this asset class because you want consistency. You want consistent income coming every single month. And the long-term plan for somebody coming to rental properties, if you want to achieve consistency, you need to have more than one rental property, because COVID or no COVID, at some point, something is going to happen and your property is going to be vacant. And you need to be able to have a diversifying effect within your assets so that when you have something that goes vacant, your two other properties that you own are buoying the effects of your returns. And if you look at this, one of these shows, Pablo, I was thinking we would do kind of a client demo that we do when we bring clients on board, and we show them our reporting, and I can show you literally, this is how we perform from a total portfolio perspective. I don't care what happens on this individual asset 1 month to the next, right? I want to manage your portfolio so that when everything shakes down, your positive cash flow is consistent. We hit your return your return expectations. And when you need multiple properties to do that. Otherwise, there's going to be a little bit of ebb and flow, which is probably one of the reasons you're coming away from the stock market.
Yeah, that's a good call. Content idea. Let us know in the chat if you want to see us break down a multiple purchase at the same time. I think that's a really good idea. And like you said, that happens, right? Like last week, somebody bought 3 properties, right, at once.
Absolutely.
So it's a great investment advice. Okay, so Lee Bishop has a comment, question, analysis here, but I love reading Lee Bishop's contributions because it really helps us. So Lee Bishop writes, $193K for a 5-bedroom is a great price for a remodel. The rent is right in that sweet spot. I like that there's no HOA, but it is on a high traffic street. I like that the maintenance is only 6%. You want to give a quick comment on high traffic streets, Gregg?
Yeah, this is something that we talked about at least a few shows ago. I was highlighting a property that was on a road. It's actually on, I don't know if it was on Wilson Boulevard. This one, the high traffic street right next to this one on Ledbury, is Wilson Boulevard. And Wilson Boulevard is I call it a higher traffic street. It's not an interstate or anything close to it, but it's probably got maybe, I don't know, 4 lanes, 6, maybe. I think probably 4 lanes, right?
Yeah. So wide enough that it gets named in this Google map here.
Yeah, there you go.
Yeah.
So here's the deal with high traffic streets. There's pros and there's cons, right? The pro is that you're going to put a sign out there. We're going to do our online advertising. We're going to get more leads on homes that are on high traffic streets than any other homes. And it's because you got more eyeballs, right? And it's also professionally renovated or brand new construction. So it's going to stick out there as well. So just getting more eyeballs is going to be helpful as far as renting your home. More eyeballs, more self-assisted showings, more homes rented right there. Yeah, there you go. That's a good look at the street. And well timed with lots of traffic on it too. I like that. Lots of eyeballs. The downside to a high traffic street is that not everybody's going to like it. And so you're going to not appeal to everybody, right? People who have young kids, people who have pets might not choose that home. So it's a balancing effect. I neither love high traffic streets, or I don't avoid them. And the last time on the last show, I think I was showing, I think it was 9 other homes right there on Wilson Boulevard that are currently owned by clients, that are rented, that are performing, that have been owned for many, many years. And so, I'm indifferent to them as long as the numbers work, and, I've had great success with them.
All right, great. Guillermo Montes has a question. How is a reno compared to new construction in terms of life expectancy of the major systems, roof, etc.?
So we have a standard for all of our life expectancies for our major mechanicals in the homes. I'm not the construction guy, so if you ask me to rattle them all off, I'm probably not going to do a good job there, but I do know the roof one right off the bat. And anytime we go in, we do an inspection on the roof, and it needs to be at least 10 years of life left on the roof. And you may say, well, Greg, how do you know there's at least 10 years of life on there? We have great roofing contractors in our vendor base. Our roofing contractors, many have been with us for over 5 years, some over 10 years, and have inspected hundreds and hundreds, probably thousands of roofs for us. And so one thing we do is they'll go and they'll inspect the roof, and they're clearly incentivized to tell us that it needs to be replaced. And if they tell us that it is in good shape and it's going to last for at least 10 years, they're going to give us what's called a life letter, which is them putting their reputation on the line and saying, I certify that there should be at least 10 years of life left in the roof. So a similar process for all of the major mechanicals as far as inspections, making sure that they're there. A common question is like ACs. We understand how important it is to have a really great AC unit here in Florida. I won't say 100% of renovations have brand new ACs, but I'll say 99%. Probably 99.9% of renovation homes have brand new ACs that are put in there. Your plumbing, your electric, those things are taken care of the right way to make sure that you do not have deferred maintenance. Because if we were to put you in a home, if you were to sell you a home and then you had one of these major expenses, it would take years for you to overcome that expense, a $2,000 expense, a $3,000 expense, maybe more, right, for a roof, right? If you had one of those expenses in your first few years, it would take you a long time of positive cash flow of $200 a month or $300 a month to get you back there. And we just can't have that happen. So we go in, we make sure our team, obviously we have general contractor who heads up our director of construction here within JWB. And then we have subs who also have licenses. And then we have vendors who, like the roofing vendor that we talk about here, that also make sure that you're not going to have that deferred maintenance.
Great answer, man. Listen, Greg, we've got 15 minutes and 9 questions that are open. Some of these, if you can, there's some that I think are going to require some good explanation, but I want to honor the people in the order that it was asked. So if on the ones that don't require explanation, I'm just going to let you know, go short, right? So we can get to everybody.
That's hard for me to do, man. I'll do my best.
I know. I'm just giving you the feedback. Mike Foster asks, do any JWB properties have either a 2-car garage or basement?
Yes. As far as 2-car garages, that's quite common. The new construction homes, generally will have a 2-car garage. Harder on a renovation. Basements, no, haven't seen one.
All right, welcome to Florida. Jackie Hung asks, public record shows that this property is a 3-bed, 2-bath. Yours is showing a 5-bed, 2-bath. Did you repartition the house to make it 5 bedrooms, and was it done with city permit?
It's a good question. I don't know the answer as far as the actual construction, whether or not we repartition the house. We do that, but we don't do that all that much, to be quite honest. Many times that city data that you're looking at is just flat out wrong. You see it constantly. They put something there. It's not 100% accurate. Maybe it was that way 50 years ago when the house was built. So I don't know with certainty. I can tell you if it needed to have a permit to have it done. And if we did it, then it certainly had a permit to do that.
All right. Pat Staub asks, how easy is it to get non-recourse financing versus conventional?
Non-recourse financing, for anybody who's not aware, basically that's financing that you'll need when you purchase properties in your retirement account. Completely different than conventional financing. And it can be a great asset for you to be able to increase your assets in your retirement account, purchase rental properties in your retirement account. For most folks, it's incredibly difficult. Many of you have never even heard of non-recourse financing. Many of you have never heard that you can actually buy properties in your rental, in your retirement accounts. With JWB, we have the relationships to that non-recourse financing is relatively easy to obtain. So I would encourage you to reach out to my team. I'm sorry I didn't catch the name, but reach out to my team. If you haven't spoken with them yet, we will get you connected, and really we're going to help you build your plan to see how retirement account purchases are going to fit into your overall plan to help you accomplish your goals. And you can go and schedule your own time to chat with my team at
chatwithjwb.com. Putting it in the chat right now. And that was Pat Staub. Pat, go to chatwithjwb.com and you will be able to pop into the guys' calendar appointment and they will answer it specific to you. Next question. Nancy Wise asks, it's actually, she put in 2 questions. I'm going to combine it. She said, I thought the federal moratorium, CARES Act, came to end in July 25th. And any idea when the eviction moratorium will be lifted in Jacksonville?
Yeah, we all thought that was going to end the end of July. And then we thought it was going to end the end of August. And we thought it might end sometime around now. And it has, and it's been continuing to be extended either on the local level or the state level, and now the federal level has been extended for the eviction moratorium. I don't know when it's going to end. I have no clue. I certainly hope that it does. I feel that it's unfair to property owners. But, my opinion doesn't really matter when it comes to the federal government. So I don't know. But what I do know is there's a lot that we can do as a property management company, as a managing your assets for you to continue to collect, 97% of rent, and to continue to put you into an asset where you're going to have a great resident who has a well-paying job right now, who is not, who is not as likely to be affected by COVID as, we may have been in the past. So I think you're in a great spot for future investments, and we can still do a lot to make sure that we limit this kind of negative situation that we're all in.
All right. Yeah. Well said. And, I see it as, if you're going to be in this asset class, you need somebody that's thinking long-term, like you think, right? Like whether you're an investor or not, you want to be thinking long-term, you want to be thinking long-term relationship with your clients and with your tenant, with your residents. And I invite, who was it that asked? I missed that. I invite,
Pat Staub?
No, Nancy Wise. Now I invite Nancy to check out our past episode with Melissa Gillespie of how JWB does property management. It's pretty eye-opening, the amount of relationship that's there and how that can drive the behavior that is, paying your bills because you owe it to the person that looks out for you. So without further ado, I'm going to go to Mike Foster, who always asks awesome technical questions. JWB's property analysis spreadsheets appear to only factor annual depreciation into the estimated tax savings, but not mortgage interest deductions reportable on Schedule E, which would result in higher ROI. Is that an oversight, or am I just not seeing it on the spreadsheet? And if you want, I can pull it up, Greg.
I can take it without the spreadsheet.
Okay.
That's a really great question, Mike. So the answer is everything is fully being counted. We're not missing out on anything that would otherwise improve our return on investment. What Mike is talking about is how you can write off a lot more than just depreciation of the asset. And hang with me here. Depreciation is just a tax term in this sense. It is not your asset going down in value. It is depreciation from a tax perspective. So we don't specifically list out that, your property management fees, right? Your maintenance costs, your taxes, your interest costs. All of these things are tax deductible as well. The way it actually nets out there, Mike, is we're taking your net operating income after those deductions are taken out. And then we are saying that you also get an additional deduction from depreciation. And that deduction from depreciation might be $2,000 a year, or $3,000 a year, or $5,000 a year. It might be something along those lines. And that net amount of cash flow for you might be, let's say, $300 a month, which is $3,600 a year. What we're saying here is that that's netting that out. So that $3,600 took into account all the other deductions, the interest, the taxes, and the property taxes, insurance costs. You're left with $3,600, and then you get an additional write-off from depreciation, which is probably at or above that $3,600 of positive cash flow. And that's how we're saying that you save on taxes and defer your taxes this year by investing in rental properties.
Well explained. Now I'm excited. Now, anytime Monique Terry has a question for us, and if you keep coming back, Monique, you are our wordsmith, right? I don't often, I feel like I have like a really big vocabulary. I had never heard the word habitude, right? So like I'm super into anybody that comes with new words into the arena. So our wordsmith, Monique Terry, asks, are we using state or national averages when determining expenses allocated to maintenance, insurance, etc.?
I love this question. We are not using state. We're not using national. All that stuff is not relevant to you. The biggest determining factor for you will be, from a maintenance perspective, will be your property manager and the construction team that renovated your home. So you're using JWB data, right? We've been tracking all of our data since 2011. Every single dollar in, every single dollar out for everything: rental income, property taxes, property insurance costs, and of course your maintenance costs as well. So that 6% figure that you saw at the bottom of the evaluation that's that number that we've seen across 2,000 properties that we've been tracking since 2011. That's how we get that number. And that would change for a new construction home. New construction is slightly lower. And that's because out of those properties that are new construction, we see that is it's actually 4% for maintenance costs. That's what we've proven it to be. So you're using the best data possible. It's based on JWB's data, which is what the biggest determining factor of what your maintenance costs are going to be. Your property taxes, when available, those are going to be from previous year's taxes, and then we bump them up a considerable amount because there's a new sale that goes into place. I'm not sure about the other costs, but they're all hyper local. If it's like a tax thing, if it's an insurance cost, it's an actual insurance estimate that we have our insurance team actually prepare for you based on that property. And then maintenance costs is actually what JWB has performed for that type of asset.
If there's anything I like more than learning a new word, it's when Gregg Cohen steps up in his chair, leans into the mic, and booms into it, man. I love it.
Oh, did I do that? Oh, sorry about that.
No. I mean, in a good way. Like you were pumped to answer that question, man. I love it. And I'm going to keep going with this, right? Monique, our reigning wordsmith, until somebody else gives me a word that I haven't heard of before, I'm going to refer to Monique as our reigning wordsmith. So Monique, if you ever come back, you got that title until you get dethroned. So our reigning wordsmith, Monique Terry, has another question. Do you recommend diversifying property types such as single family, duplex, triplex, or etc. to leverage risk?
I really like all types of those asset classes that you talk about. There's not really different asset classes, different property types. I love single family. I like duplexes and triplexes and quads, right? They make sense to me. But the problem is that you're not going to see a lot of those in Jacksonville. The housing stock is largely single family in the neighborhoods that you want to be in, right? JWB could go and find duplexes, triplexes, quads, but they're going to be in those low income neighborhoods, and we're going to defeat the purpose for you, right? So just in Jacksonville, you're going to see single family homes. The one caveat to that is townhomes. That is something, if you haven't considered before, townhomes can make an excellent investment for you, because JWB has been building new construction townhomes in our neighborhoods on the west side, right down the road from Ledbury, this property we were just talking about. And that's a great way for you to get the economies of scale of a multifamily property and also have it be in the right neighborhood for you to get positive cash flow, to be in that right neighborhood. I think the bigger question too is, would I recommend diversifying? Diversification is great, right? But there's so many different variables to consider when making the right decision. And in my mind, I have to rank them, right? Diversifying between single, duplex, triplex, and quad, like that doesn't lower my risk in my case, right? I don't see a huge value there. And when you're trying to make the right decision for investing in rental properties, the biggest things you need to focus on, you need to find the right team. You need to believe in the property management team. They're like your financial advisor for your rental property, your real estate portfolio. So you got to find the right team that you can connect with and you believe in. That's the most important thing. Number two, you got to find the right market to invest in, right? You got to find a market where you can get both positive cash flow and be positioned for long-term growth. And that's really hard to do, right? Jacksonville, obviously, I'm biased, but there's not too many out there. So there you go for that. And then after that, you got to choose the right dynamics of the neighborhood to invest in, right? Like, you can't go to the low income neighborhoods in Jacksonville because there's too much maintenance and vacancy and turnover there. So you got to find them in these below middle income neighborhoods. So what, out of everything you're trying to do to make this right decision, and you're putting all these filters on that I just talked about, it's really hard to find those assets that check all of those boxes. Now, if you were going to throw in another qualifier of like, well, I need to have 20% single family, 20%, duplex, 20%, that is the least most important thing to me as far as diversifying. So short answer, as I'm not very apt to do, would be, no, I don't place a high value on diversifying between those different types of properties.
Excellent, man. Listen, I was telling you to speed up through the first ones because I wanted you to explain these last couple, because I thought that they were really valuable, unique perspectives that I personally hadn't heard on the show before. So I think it's great. Scott Bellotti has a question here. Do tenants have to prove they have been affected by COVID under the eviction moratorium?
Yes. So kind of clarify a couple of things. There is that eviction moratorium out there. However, what has happened now is you can evict people who have non-payment, who have not been affected by COVID. So the burden is actually placed on the resident at this time to prove that they have been affected by COVID. This is different than what it was in the past. 2 months ago, you couldn't evict for any reason. So now you can evict, but the burden of proof is on the resident. And if they have been affected by COVID, then you cannot evict. So this is something that we are handling now. We are moving forward with evictions when it can be done appropriately. And I just walk gingerly on this because the burden of proof for a resident is not very high. And I think that's okay, right? So that's just kind of where it is right now. So we are taking those steps, but it is something that it's not like it was before as far as your ability to evict people. You just have to walk gingerly into it.
Got it. That's it for the Q&A box here. And I realize I've been swimming so much in the Q&A box that there is some more questions in the Facebook group. I don't think we can get to all of them because we're wrapping up here. I'm just going to throw one up there to acknowledge the Facebook group. But if you're watching on Facebook, I encourage you that you join us on the Zoom call so that it's much more interactive here. And it's Andrew Nam asks, what's your take on Airbnb versus long-term rentals?
Yeah, it's interesting. I mean, I think Airbnb, prior to COVID, there was a huge rush for short-term vacation rentals. It was one of the hot things. And then, here in Jacksonville, you couldn't do a short-term rental for a few months. It was not allowed. And it really exposed, a concern in short-term rentals. So I'm going to kind of move past that. I mean, as far as, I moved past COVID on a lot of things, right? I'm a long-term thinker as far as rental property investing, and short-term rentals, I'll kind of move past the COVID concern there. Short-term rentals can be a great investment for you, but you need to think about what you want most out of this investment class, right? If you're coming here because you want the best returns and you're willing to put the work and to take the risk in order to do it, then short-term rentals should be a way that on a cash flow basis, potentially you can earn some better points of return, right? You can earn more returns on the cash flows. Like, saying it another way, 10.4% here for the Ledbury property that I just showed you. I don't know, I'm throwing numbers, but maybe that's a 15% return on the cash flows, or a 20% return maybe on the cash flows from a short-term rental perspective. But then you got to either factor in your time to manage it or the property manager's time. And if you start to take some of those costs into effect, the returns come down a lot. And ultimately, you probably can earn a few better points of return, but you come up with a little bit more, well, you come up with a lot more hassle, and you come up with either management yourself, which takes a lot of time, or you come up with a little bit more time of managing a property manager who has a lot more turns. Like, saying it another way, JWB, we rent properties on 2 or 3 year leases, and we serve that resident, serve them as best as we can, right? We would have to put so many more resources, and we'd have to have so much more communication with you, and you'd have to make so many more decisions, and you'd have so many more little ticky-tacky maintenance items if we had a new person in every single week. So bottom line, it can be a good investment. If you're searching for the absolute best cash flow returns in a market, you might consider it, but just know what you're stepping into. It's more work, more headache, more hassle. And if you want to be completely passive, long-term leases will probably be the best bet for you.
There you go. I like that question for you because it really differentiates you from everybody else, right? Like, I think that you preach the gospel of passive investing, right? So like, from everything I've learned from you, rental income properties through JWB is by far the most passive thing you can do. It's buying a home that is lived in by somebody else, and you really don't have to worry about it the least possible than in any other kind of like situation. And you value that greatly on a time perspective, on a mental aptitude perspective, and the return on investment on cash flow and appreciation and all the other profit centers for you make it worth it if that is the range that you want to be in. Now, if you want to value short-term cash flow and value less the passiveness of it, then that is something to look at. Is that well said?
That's true. That's exactly true. And I wanted to add one thing onto that, which is why in my head it makes so much more sense to hold on long-term and be passive. It's because, when we showed the property on Ledbury, we showed that there was roughly 10.5% returns from the cash flows. And we showed if you're a long-term buy and hold investor, you can count on appreciation. Your total returns are about 25% a year, right? So in my mind, call it 15% of your returns are coming from appreciation long-term, and 10% is coming from the cash flows. Why would I work 25% harder or 50% harder to earn 3, 4, 5% returns on the cash flows? You know what I mean? Like, to me, that doesn't make sense. It's like, my job should be, how do I manage my assets so that I can get as many of these rental properties into my income producing army, and then ride the wave of growth over the years as I buy and hold? Like, that's what makes more sense to me,
I love it, man. I love it. I love that we went there. We are 6 minutes past the hour of being here. This is longer than usual, but I thought it was extra valuable. We have still 30 people with us. Thank you so much for spending a Thursday afternoon with us. It really does. When Gregg says that it means a lot to us that you're here, it means a lot to us that you're here, right? Like, you saw that you drive the show, you drive the discussion. We're here to serve. And kind of like in Beauty and the Beast, there's nothing more unnerving than a servant that's not serving. So without you, it doesn't work, right? So thank you for being with us. Thank you for spending this time together. I encourage you to go to jwbwebclass.com. Download that spreadsheet that I was just tinkering around with. Get your property evaluations. Get educated on this rental income property class, because it really is an amazing world of education that's out there in this. And I'm just scratching the surface and really enjoying it. And besides that, next week, we got Jen Filson as our guest, who I
Yeah.
had the great fortune to prep her for the show. And then she invited me on our podcast. And then we had an amazing hour-and-a-half conversation that we posted inside the Facebook group. Super vulnerable. She is a fascinating person that has creatively come up with funds to invest in these properties, because she lives in Monterey, California, where the cost of living is ridiculous. So she actually rents her place and invests in properties in Jacksonville, which I think is fascinating. I think there's a lot to learn from that. And I'm going to get off my soapbox and lob it back over to Gregg to kind of take us away here.
You know, Jen Filson and Renee, her husband, incredible people. You're going to love meeting them. But the topic is so timely. I probably get a question a week, specifically people reaching out to me on the comments in the group or whatnot, asking, how do I come up with strategies to add my first rental property into my portfolio? Right? How do I use creative strategies? Well, you're going to talk to somebody who actually did it and is a current client of ours for many, many years. No better person to kind of speak from experience there. So Jen, I'm super excited. I know she was on the call earlier today too. So Jen, I hope you're still here. We're super excited to have you. And again, another heartfelt thank you to all of you for joining us. I think this was our highest attended Thursday session. So I hope and welcome all of you to come back on Thursday. We do the property evaluation of the week every Thursday. That's where we reveal it here and this breakdown. And couldn't be more happy to be here with you all. So thank you again for all of your support, and we'll catch you on Tuesday.
Adios, everybody.